LZB just missed fiscal Q1 2027 consensus across the board. I mean, revenue came in at $476 million, missing the $495.45 million estimate, and adjusted EPS was $0.43, which missed the $0.49 estimate.
Right, and it gets worse.
Yeah, it does, because Q2 sales were guided softly to that $500 to $520 million range, well below Wall Street's $536.8 million target. The market basically punished the report, sending shares plunging roughly 17% to around $34.
But, going through this earnings report for our deep dive today, our goal is to figure out if that 17% haircut actually tells the whole story. Because beneath that headline miss, there is a really sharp divergence in how their different segments are actually performing.
Divergence like what?
Well, their company-owned retail is actually thriving right now. Delivered sales, like when the couch actually arrives at your house, those rose 10% to $229 million.
Wow, 10% is pretty solid in this environment.
Exactly, and written same-store sales grew 3%, with segment margins even expanding to 6.5%.
Okay, so if retail's booming, where's the drag coming from?
It is entirely from their wholesale division and Joybird, which is their direct-to-consumer brand. I mean, wholesale delivered sales fell 9% due to these really choppy order patterns.
And Joybird.
Joybird remains just a massive drag. Their written sales plunged 17%.
That's a huge drop. It's honestly like running a restaurant where your main dining room is totally packed, but the drive-through is just hemorrhaging money.
That is a perfect way to look at it.
But I have to push back a little here. If retail is booming, but wholesale and Joybird are dragging the whole enterprise down, is the wholesale model just fundamentally broken for this macro environment?
Well, that wholesale drop is directly connected to their bottom line miss.
Yeah.
Consolidated adjusted operating margin compressed at 3.9%, down from 4.8%.
Right, because the fixed cost deleverage, I'm assuming.
Exactly. When wholesale volumes drop, you still have to pay for the factory overhead whether your assembly line is running at full capacity or not.
Yeah, it makes sense.
But on top of that, management is deliberately incurring what they call friction costs right now.
Friction costs? Like what exactly?
They're completely overhauling the supply chain. So they're closing manufacturing plants in Mexico, specifically in San Luis Rio, Colorado, and Tijuana.
Oh, to consolidate Joybird and other manufacturing back into their U.S. network.
Right.
But wait, they're pouring capital into new distribution hubs, they're opening 10 new stores, and they're spending on digital tech, all while revenues shrink. Are they trying to fix the roof while it's raining? I mean, is this brilliant long-term positioning or just a dangerous capital burn?
It looks like a dangerous burn until you look at their safety net. They are sitting on $267 million in cash and zero external debt.
Zero. Okay, that totally changes this.
Yeah, they are betting that optimizing everything right now is going to yield disproportionate market share when consumer demand actually recovers.
So they're basically weaponizing that pristine balance sheet to outlast the weaker competition.
That's the exact playbook.
Which leaves you, the listener, with a really provocative question to think about. Because with 90% of upholstery production now domestic, LZB is highly insulated from tariff risks.
Oh, totally insulated.
But that exact footprint leaves them highly exposed to fixed U.S. labor and factory costs. So if the broader furniture market's recovery takes years instead of quarters, how long can they actually sustain this heavy investment year spending before that pristine balance sheet starts to crack?
That is the ultimate stress test for them.
Make sure to follow the show for your daily earnings coverage.